right? Here we have a company, LCN. They enter into a 6-month, 12%, 9,000 note, okay? So the 9,000 is your principal. The 12% is your annual percentage rate. And this is the life of the note, okay? This is the date the note is created. Right, so they're giving you all the information you need, even if it's not in a promissory note, we have all the details we need. Okay, so the first thing we're going to do is record related journal entries. I want to start simple first. So let's change this. Let's change this to January 1st, and then we'll come back and do it November 1st, just to start simple. Okay. All right, so we're going to record all related journal entries. So first we have to make one for January 1st. On January 1st, the company takes out to record loan from First Trust Bank. Okay, so it's going to look like the first scenario I gave you in our example earlier. Here we go. There's our journal entry. Debit to cash. Credit to note payable for the principal. Now, the next time we make a journal entry is at the note's maturity. Okay, so 6 months later. Let's see, February, March, April, May, June, July. So July 1st is our maturity date. Okay, to record maturity of note. We're going to assume that we honor the note. It's called honoring the note. So a customer honors the note, or a client honors the note, honors note payable if company pays principal plus total interest at the note's maturity date. Okay, so in 6 months, we're going to assume the company is honoring the note, meaning they're paying it, just like when we pay off any liability, right? When we pay off accounts payable, there's your journal entry. Now it's going to be notes. So start with the easy pieces. Debit notes payable to decrease it. Notes payable is always recorded at principal, right? Just like it was up here. We have to pay off cash. The cash is going to be principal plus total interest. Okay, to figure out total interest, we're going to use that formula I gave you in the last video. Okay, that formula was PIT. Okay, PIT. Principal is 9,000, interest 12%. 6 months have passed, right? Time passed. 6 months over 12, always over 12. Okay, that goes to interest expense, 540, and cash is the sum. There you go. Okay, you did your first journal entry to record notes payable transactions, right? Taking out the loan and then paying it off plus interest. Okay, now remember, I changed the date the note was created because I made it nice and easy that we paid off the note in the same calendar year. Okay, right? So we paid it off on July 1st. So we paid it off in the same year, same calendar year. Okay, what makes it really hard is when we don't pay it off in the same year. And so now by changing this date back to November 1st, we're going to have that situation. Okay, so let's see what that would look like. All right. So let's change this to November 1st. Okay, the journal entry for the date the note's created, it's the same. That doesn't change. Okay. Now, November 1st. Now, it doesn't look to scale, does it? November, December. Let me move it here. Okay, so we've only had it for 1 month in, let's say, 2022. 1 month, oh, sorry, 2 months. All of November, all of December, 2 months. If it had been November 30th, then it would have been 1 month. Okay, so we've had it for 2 months in December. Now, if you remember, the matching principle says we have to record all expense in the period in which we gain the benefit, right? So we borrowed funds for 2 months. So we have to record or accrue 2 months worth of interest at the end of our year. Okay, so at December 31st, we are going to have a journal entry to make. We are going to accrue interest on note payable. This isn't your first time seeing accruals, right? We did that in chapter 4. So we are recording interest expense to follow the matching principle. And if you think back to chapter 4, whenever you increased an expense on the accrual side, the offset was a payable. So it'll be interest payable. To figure out how much, we're going to use our formula, our PIT formula. Principle's the same, interest is the same. What's going to change is the amount of time that has passed. Okay, the amount of time that has passed now, 2 months. All right, let's figure that out. So we're going to record $180 worth of expense in this year, right, in 2022. The rest we'll record in 2023. 4 months worth. Let's see, December 1st, January 1st, February, March, April, May 1st. Okay. All right, so we've already recorded this 180. There it is, expense in the same time period, done. So now we have to record the journal entry at maturity. Assuming we honor the note, our maturity date is May 1st to record payment of note at maturity. Now, if you think back to the last time we did this, when I had it change the date from November to January, maturity, right? Your journal entry was notes, interest expense, and cash. Okay, those are all going to stay. You're just going to have one extra account. So let's go ahead and put those in. Start with the easy stuff. Notes payable is always recorded at principal. Interest expense, wait, we're going to calculate that using PIT. Cash, wait, that's going to be the sum of principal plus total interest. There's one more account we're going to need if we have to accrue interest, and it's interest payable. Why? Because on maturity, you're paying off everything you owe. We owe 180. We're paying it off, so debit to remove it. All right, let's figure out how much interest expense has happened in the new year. 4 months worth. So let's update this calculation. I believe it's 360. I wanted to solve it 2 ways just to make sure. 360. Okay, so if you work our formula this way, you get the 360. The other thing I did is I know that our total interest was 540. We solved that in the last one. We've already accrued 180. So what's left to accrue is 360. Okay, add it all up. Your total's still going to be the same, the 9,540. It's just whenever we don't pay it in the same year, we have to accrue, and that creates this new journal entry and then an extra account down here. All right, you're going to have one of these to practice, and I definitely recommend that you do, because as you can tell, it's just a little bit extra. All right, so we talked about yet another new current liability. Short-term notes payable. And all the journal entries that go with the short-term notes payable, right? You might have to accrue interest, for example. Good. We'll see 2 more new examples before we finish the chapter.